was a lot to review this week. Most importantly, the highly anticipated Fed report came out, followed by Chairman Powell's report, and it was interesting, but it was as expected, a 25 basis point hike, followed by a wait-and-see attitude.
Right, and really the most important thing was a single word. In the prior press conference, Powell said that he anticipated that further rate hikes will be necessary. In this most recent press conference, he said that the economy and data will determine whether future raises are necessary. And right now, the market believes that the Fed is in a pause mode.
Yeah, so there's really three choices here for the Federal Reserve. It is to continue to hike, it is to pause the rate hikes, or it is to pivot and start to send them down. And so right now, it is a wait and see. We'll see what the data is, but I will tell you, the payroll report that we got on Friday morning was not good for his argument.
Not really. I mean, the jobs report, we had at 253,000 jobs in the month. The estimate was for 185, but it really wasn't as strong as it looked because there were downward revisions to February and March by 150,000. So the jobs market is still strong, as Powell indicated in the press conference, but it is showing signs of weakness as job openings continue to diminish.
So the job openings is one thing, but the unemployment rate went from 3.6 down to 3.4%. Wages went up, and so it is the big reason why a lot of people are just saying it's a flip of the coin on will there be a recession, because as you recall, the definition of a recession changed last year in Wikipedia, and it wasn't just two back-to-back quarters of negative GDP. They looked at employment, and employment remains really strong, and that is going to be a difficult argument for the Fed to make. So we'll watch that. We got the payroll report, we got the Fed, and of course we're in the middle of earnings season.
Right, and earnings season has gone better than feared. We heard from Apple, for example, on Thursday night. They reported a better than expected quarter. They announced a $90 billion buyback. They raised their dividend, and iPhone sales were better than expected. So Apple, the largest market cap weighted company in the S&P, triggered a sharp rally on Friday after 4 down days. So the markets finished lower for the week, but they are surprisingly resilient given the things we've heard about the regional bank sector and the banking system in general.
So let's go back to Apple just for a second. It's always interesting to listen to these calls and the fact that Apple's revenue was at a record high, especially in India. India now bigger than China, shockingly.
Right, and India's been a difficult market to break into, and of course it's the most populous country on earth. Most people don't know that, and obviously that's a new opportunity for Apple as they continue to extend their dominance. Again, Apple is not a cheap stock. It's highly and widely owned, but again, they delivered, and people were happy about that on Friday.
So let's talk about that for a second. You talk about the rally that we have, 4,100 or so on the S&P 500, off of a low of 35 to 3,600, but a lot of that gain comes from these big names that you've outlined.
Right. 10 names have essentially accounted for all of the advance in the S&P 500 year to date. That's a dangerous situation in a sense because a narrow leadership can certainly reverse as valuation thresholds are reached. And we've talked about this a lot on our investment committee that, the economy still remains strong, but the effect of all of these interest rate hikes are yet to be felt. Not only the interest rate hikes, but also the possibility that loan growth will slow at regional banks as they're forced to hunker down a little bit as depositors flee for higher yielding spots to go. So there are a lot of cross currents, and that's why we kind of recommend a balanced approach to the markets. We believe there is upside, but not a lot.
And so let's talk a little bit about the earnings, again, put a bow on that. Earnings season is coming to an end. It is better than expected. It's down as expected, not down as much, but better than expected. And about 80% of companies have already reported.
Right. EPS growth in the S&P is now tracking at minus 5% year over year. When earnings season began, the thought was it would be minus 7%. So better than expected. Again, a low bar. So the real key is going to be what's going to happen in Q3. Right now, the Atlanta Fed is not forecasting a recession. In fact, their Q2 estimate for GDP, which will affect Q2 results, is for an increase in GDP of over 1%. So the slowdown that everyone's waiting for has yet to materialize.